Good Friday morning, Market Chameleons. Thanks for joining us for the Market Chameleon pre-market show. If you've joined us for the first time, much appreciated. And there he is, the King Chameleon, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer? It's up there for us all to see.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
So do you think someone from the Wall Street Journal was watching the show yesterday?
Yeah, you were telling me about that. We're discussing Amazon valuations, and
yeah, they were talking. There's a big article in the Journal. Everyone, I suggest you check it out today, talking about basically what Dee walked us through with Amazon's the revenue actually shrinking, basically, and you know how the growth during the pandemic is now easing in a big way, and how they're going to try to manage it. It's so there's a lot going on within that stock, but there was a great article today, and it spoke about a lot of the things you were talking about yesterday. So thanks for the early heads up on it.
Thanks. I'm going to take a look at read the article myself. It's interesting to see their perspectives. So, but what I think we'll do today is, well, as usual, if you guys are joining us for the first time and you have any questions, put those questions on the live chat on YouTube. Will's watching them. He'll read it back to me. If you want to come on a show and ask your question live, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Click raise your hand. You could ask your question live. You don't have to turn on your video camera. While we're waiting for any questions to come in, I think we'll take a look at the pre-market report. And somebody asked about Tesla and Tesla's valuation. So maybe we'll take a look at that as well today. So those are the two things on deck.
Perfect.
All right, let's start with, I'm going to share my screen. We'll go to the pre-market report, and these are stocks moving in a pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see 145 stocks made our percentage gainers list, 32 on a percentage decliners list. So from that perspective right now, we look like a more bullish bias at the open. I'm going to filter out this list to look at S&P 500 stocks only. This will take out any small cap stocks, ETFs, leverage products. We can remove all those, just look at S&P 500 stocks. To do that, I'm going to use this filter here in ETF and drop it down, select SPY. The SPY is the S&P 500 ETF. And let me see, I think I got to refresh my screen. I think my screen went stale. I know we were having, you and I were both having technical problems in the morning, but in ETF, drop it down. SPY, by selecting SPY, this will filter the list by SPY holdings, which are the S&P 500 constituents. And we see here 21 made our percentage gainers list, 1 on the decliners. So a little bit of bounce here, probably at the open after yesterday's big sell-off. If there are no questions here on the pre-market, or we don't have any other questions, maybe what I'll do is move on to Tesla.
Sounds good.
Okay. So here in Tesla, I think the question was, we went over Amazon yesterday and looked at, its valuation is a potentially, a good deal, overvalued, undervalued. We did that yesterday. So the question was to do with a quick, analysis on Tesla. So that's what we'll do today, is take a look at Tesla's valuation. Right now, $640 around $662 billion market cap. What do we think, fair value is based on how other stocks are priced in the market, future expectations of growth and earnings. All right, so that's what we'll do. And I do want to say that there is no one right model, right? There are models. Usually you start out something with simple and then you grow it and give it more inputs, give it more adjustments, give it more tweaks. So we're going to do it today from the beginning stages of simple analysis. All right, maybe not very simple, but it won't be too many inputs. And before, so the model over here, it's a calculator we created. We have two ways to compare it. One is to look at its historical multiples, compare its historical multiples to the present valuation and see how far it is from there. But, I don't really, sometimes I'll just look at that, but I really go to a different calculator, which takes into consideration, well, what do we think earnings are gonna do? What do we think profit margins are gonna do? And what do we think earnings and profit margins are gonna do in the rest of the market? And from a comparative relative basis, do we think, is Tesla a good deal or not such a great deal? All right, so I'm gonna skip this right now and go to this new calculator, the comparative model. And so right now it comes up, we have a market price and a theoretical value. And this theoretical value is going to be based on some assumptions. All right. And we could change those assumptions to change the calculation. And the two most important assumptions in this model is the following. What do we think Tesla, what are their revenues going to grow relative to the rest of the market? So that's the first estimate we need. Another estimate is what do we think their profit margins are versus the rest of the market, right? And then when we compare the two, we want to know on a valuation basis, well, how much then should I be paying for Tesla just to equal the market's return? And am I getting a good deal or not? And that's the question. So I'm going to come down here really quickly. We made it very simple right now, so it's not complicated with too many inputs. But we could see here, I'm comparing Tesla and SPY. And I see here, these are Tesla's operating margins. Operating margins are their profit margins coming from their core business. All right, so if Tesla sells cars, if it costs them $100,000, let's say they sell a car for $100,000 and it costs them $80,000 to make that car, they have $20,000 left over in profit. That means there's a 20% operating profit, operating margins, okay? So that's what this is. And we want to compare that to the rest of the S&P 500, SPY. So here we see in the most current quarter, Tesla's profit margins were 19%. And the good thing here is that that's above its 3-year average and 5-year average. So their profit margin, and we'll take a closer look at that, but it did increase. So that's a good thing, and we're going to use that right now as our basis for the calculator. And then we see that at the same time, S&P 500 margins also increased a little bit from 11.1 to 12.9. And we'll start out with those assumptions, and then we could change it around based on other factors, okay? But let's start out with that. And then the next thing we want to know is, okay, Tesla is potentially will have more profit margins than the rest of the market, S&P 500. What about its growth, right? So what about its revenue growth? So we know it's going to make, if we think assume it's going to make 19% of its revenues, it's going to keep as profits. what do we think from year to year is its revenue is going to grow? And I go out about 5 years. So this calculator, it's a 5-year horizon. And here we see that their revenue growth was in the last 5 years averaged year over year 48.7%, 3-year 40.1%, last year it grew 73%. So we have to choose one, and what do we think it's going to, year over year for next 5 years. So when we talk about, let's say 50%, if you start, year one, it grows 50%. Year two, it's going to grow another 50%. From there, year three, another 50%. So it's cumulative, right? So it keeps going higher and higher by 50%. S&P 500, we see 3 years, 7.5%. So let's do this first. Let's say if the next 5 years continues on a similar path as we've seen on average the last 3 years, so 40% for Tesla, 7.5% in SPY, 19% profit margins in Tesla, 12.9% in SPY. What do we think Tesla would be worth based on that? And I'm not taking into consideration right now volatility or risk. Let's keep it simple. So I'm going to recalculate that. And I'll take the recalc. Is this calculator? So based on that, we think that the Tesla would be worth 500. So how do we get there? Let's take a look at the results. The reason we think it is the following. If we took SPY, right, we started with its revenue, and year one, this is its profit, right, 12.9%. Year two, revenue grows by 7.5%. Year two, that's the profit. Year three, revenue increases, profit. So in 5 years, this is the profit. That meaning if you bought the S&P 500, kept and you owned all the stocks outright, you're entitled to all those earnings. And in 5 years, if you bought S&P 500 at today's prices, and these earnings estimates were correct, in 5 years, your total return would be 35%. Okay, so that's what you would yield, 35% over a 5-year period if you got to keep all the earnings, paying today's market prices, paying today's market cap. In Tesla, right, here's year one. This is the start of your revenue. Profit margin 19%. This is the profit you would keep in year one. Year two, we assume revenue went up 40%. So year two, your profits would be even higher. Year three, your revenue went up another 40%. So your profits are higher. So 19% of that revenue you're keeping. So in 5 years, you got all this, right? All these earnings. But what is your return? What is your return would be what you paid for Tesla stock, right? So what did you pay for all of Tesla stock? Well, that's $662 billion market cap. So your return would be 27.4%. So from that perspective, if our estimates are correct, right? If our earnings estimates are correct, if our growth estimates will be correct, in a 5-year horizon, 5-year period, even given 40% growth rate, even giving them 19% profit margin, our total return on the investment would be lower, right? Because of the market cap here. So now that doesn't, maybe our estimates are not correct. We could adjust them. Let's look for more clues on why they, what the market may be seeing, what we may not be seeing. But remember, those are our basic initial estimates. And now to get more clues, we'd have to do some more investigative work. All right. So so far, if everybody's okay with that, let's go take a look at, what else we can find. Let me just go. Any questions yet, Will? Okay, I think you're on mute.
Sorry about that. No questions, Steve.
Okay, so I'm gonna first, let me just take a look at their income statement really quickly, just to see a couple things. So from quarter to quarter, right? Here's from quarter to quarter, we see that they do have growth. They're growing from quarter to quarter. Definitely, it's going up. These are their revenues. This is their operating income, so that's going up too. So that's pretty good. So let's take a few things, look at it. I'm going to first look at year over year growth. So what this will do is look at this latest quarter versus previous quarter. Then this is looking at comparing quarter four to previous quarter four. And this does look, at least since, there was a dip here in 2020, probably with Corona. But since then, it's had some explosive growth, right? So that they do have. This is the opposite of like what we were talking about in Amazon. Tesla is experiencing explosive growth on the top line. Let's take a look at their margins, because those are always also something that people were concerned about. So what is going on with my, hold on, I gotta refresh this. Let's go back to quarterly and let's look at their profit margins. So this will be, I'm going to look at all the values as a percentage of revenue, right? So this is looking at the revenue, and then it's dividing all this by the revenue, gross profit by the revenue, so we can see the margin. So we see gross profit margins, they're ticking up a little bit. They are ticking up a little bit. I guess if you look at it from here, from 21% to 29%, that's a big increase, almost 50%. So they're trending up. That's good news, meaning that they are becoming more efficient as they're growing. In other words, that for each car as they're going forward, they sell, they're making more profits, right, out of each car. And we could see that also in the operating margins. So we're over here, operating margins, from 5%, they were here in the low. Now they're in the double digits, 19%. So those two are still telling us there's a growth story so far, right? So up to now, this looks like a growth story, and a lot of people also consider Tesla not just like a car manufacturer, but a technology company, right? And they do have the growth like a technology company. Margins are improving. It's not quite like Microsoft or Facebook or Google, where they're like in the 30s, 40s profit margins, but they're moving up for sure. And you got to kind of go in there and look at the story. What else does Tesla? They have software. They have lots of potential. But so far, we're starting to put the pieces together, right? So growth looks like it's there on the top line, on the profit margins. So now let's look at clues for forward looking. And to look at forward looking, you'd have to start looking at different places, starting to assemble more information about macro trends, all this. But the first place I like to look at is what are the company itself, what are they guiding? Okay, or is the company guiding higher, lower? What are they seeing? Because the company itself is the closest to their business, their data, and their analysis. So what might they be telling us? So let's go. I'm going to go to the company. Let's open up the links. Let's go to the investor relations. And for the clues, let's look at their latest earnings release, because in their latest earnings release, they're going to talk about their business, their earnings, and hopefully about their future outlook. So here I'm on their investor relations website, April 20th. That's the latest earnings. And I think they have a shareholder deck. So I'm going to download this. Let's take a look. And here, we're going to try to look for the outlook, right? Just to make this quicker, we're going to try to look, what are they seeing going forward? So, they'll talk about, here they'll talk about, this is a summary of what they're talking about, financial summary, operation, vehicle capacity. Let's take a look at the outlook for now. So that's page 10, right? So I'm going to go to page 10, outlook. And two things I want to first look at is, what are they saying about their growth, right? What are they saying about their growth, and what are they saying about their operating margins? And those are like the two key components right now in our calculator. It's a basic one, but those are, I think, probably as a starting point, usually across the board, that would be, the key focal points in your analysis, right? If you're just doing something in general. So in an outlook, a couple of things here, they start out with volume, and we plan to grow our manufacturing capacity as quickly as possible. And that's kind of good, right? Because if you're growing your manufacturing, you must be positive. You think that there's a lot of demand. And over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. So this sentence here, we could kind of use as a forward-looking guidance in their revenue, because they're telling us here, they're looking at multi-year. So that's pretty good. So, we're trying to get like a 5-year outlook. They're looking at a multi-year horizon, and they think they're going to achieve 50% average annual growth in vehicle deliveries. So to me, that's saying that they're looking at 50% growth in revenue, because if you're delivering these vehicles, that means you sold them, right? You sold vehicles that you made. And if you're growing them at 50%, that should be adding revenue to around 50% revenue growth. Okay, so let's use that right now as their guidance.
Hey, D?
Yeah.
Rob did mention that they just announced that they're increasing prices. I think it was by like 5%. Is that something would change in the model as well, or is that
exactly? So that would change, and that's very good. I'm glad Rob brought that point. So you see how now more information's coming in, and when you hear that, then you can say, hey, I'm going to adjust my operating profits, because a 5% increase, unless they're seeing input prices increase by more, or a 5% increase, and if you feel like that the operating margin, expenses are staying the same, that's going to expand your profit margins. So we could actually maybe add a little bit to that profit margin. So I'm glad you brought it up, because you see how, as information's coming in, your inputs and your estimates are going to be changing. And by the way, on Wall Street, these models are changing almost daily, because we're getting different information, right? You get auto sales coming in higher or lower, right? That could change your estimate by a little bit. You get, maybe interest rates increasing, that might affect, demand for cars a little bit, based on, borrowing for, or leasing cars. So these models are getting tweaked and changed every day based on information coming in. But that's a good point. Maybe we'll add that into our model. So let's use 50% right now growth as our baseline, right? So 50% growth, they guided us there. If they're saying it, there should be something behind it. Profit, here they're saying, while we continue to execute on innovation and reduce cost of manufacturing operations, over time, we expect our hardware hardware related profits to be accompanied with an acceleration of software related products. So, I'd have to think about it. Maybe their software related products have higher margins, but they're giving us some indication that they're looking to, increase their profit margins, increase those operating margins. So let's use 50% growth right now. Let's stay with the 19% profit margin, or maybe even tweak it up a little bit based on what they're saying and what Rob just gave us some information, and see what the fair value would be if we change that. So I'm coming over here. Let's go back to our fair value model, our calculator. And now we're going to change those assumptions. And we're going to say maybe 40% might be low, the 3-year average. 73% might be high, what they grew last year. But, 5-year average, 48%. They're telling us 50. Let's put 50% in. So now I'm going revenue growing 50% per year for next 5 years, year over year. Operating margin, they're indicating to us that that's a focal point of theirs. They're working on, that operating, and I know a couple reasons that the operating margins might be increasing. They expanded into China, manufacturing. They did couple things to improve those operating margins, and they said that they're going to continue. They're raising prices on cars. That could be also, something that's going to increase their profit margin. So let's tweak it up a little bit. Let's just give it 20%. All right. Let's not go too crazy right now. Because we also want some cushion, right? We want to, if we error or something goes wrong, we still want some cushion. These numbers are pretty good already. 50%, 20% operating margin. Let's recalculate that. And at that point, if these estimates are correct, 20 and 50, right? If these estimates are correct, S&P 500 or S&P 500 estimates correct, which I didn't get to yet, then here it looks like that it could be either close to fairly priced, maybe a little bit underpriced, right? So at those levels, if those estimates are correct, we're probably close to fair value. All right. So we're right up at 9:30. Kind of wanted to walk through certain things you want to look at. When you're thinking about earnings growth, profit margins, comparing it to the rest of the market, are we here fairly valued, overvalued? And just want to say this is a starting point, right? A starting point in your calculator. There are lots of other things once you get to know the company, you want to take into consideration.
You can imagine this is why earnings are so important, because every earnings, all the analysts on the street, traders, are going into their models, readjusting, and
right,
changing their view of their position. So it's super interesting.
And even every day, because what's happening every day, first of all, the market is moving, right? So as the market is moving, you have to peg it, right? How risk assets priced? How are you priced relative to those risk assets? So those models are changing continuously, but also any type of we get numbers all the time. Consumer confidence, manufacturing, inflation numbers, all those, you'll start tweaking your model a little bit, because if you're a little bit optimistic on your forecast, you might want to start lowering them a little bit. If you're maybe a little bit pessimistic and the numbers start coming in good, you might want to tweak them up a little bit. So those are things that these models are changing, adding inputs every day.
Great job, D.
Hopefully, hope you guys have a great trading day. Stay safe out there, and hope to see you guys on Monday.
All right, Trading Peace Chameleons, have a great Friday and a great weekend. See you Monday, D. Bye.